Starry, starry night, paint your palette blue and gray. 저 별은 나의 별, 저 별은 나의 별. Go down because there's inverse relation going up. I just switched the security to Exxonmobil because I found something strange going on with the Tesla. Okay, usually, I was talking about bid-ask price. Okay, bid-ask quote, I should say, bid-ask quote. When you look at Yahoo Finance or this kind of things, your stock market, you will always see this kind of things, right? Bid price and ask price. Okay. The way I understand it is this. Here's a quote, the price level of the stock, right? More expensive, less expensive. And then there is a market maker, okay, who connects those buyers and sellers, or dealer or trader, or dealer or brokers, right, who is connecting those buyers and sellers, right? And this middleman, or you call it market maker or whatever, okay, the middleman needs some compensation. This is not a voluntary job, right? 봉사활동, no way. They want to get compensated. That's why they work in finance anyway, right? How do they get paid? Well, they get paid with this bid-ask spread, something called bid-ask spread. Okay, so the way I understand it is this: in a vertical line, AB, ask, bid. Okay, price, and then this is a quote. Quote, which means 호가 in Korean terminology. 호가, 매수 호가, 매도 호가 kind of things, right? 사실 때, 파실 때. If you go to foreign exchange, right? When you want to change your Korean won into US dollars, right? And you always see this kind of two quotes going on. Dollar, when you 사실 때, when you 파실 때, the price is different. Oh my God, why is that different? Because those middlemen want to get some fees from you, right? So that when you buy this asset, either it is dollar or, in this case, stock of Exxonmobil, right? The petroleum company, right? Petrochemical company, right? When you buy this stock, you have to pay higher one like this. And then when you sell this stock, you have to sell it for this lower price. Then what happens? The difference, okay, is something, okay, this middleman gets. Make sense? That's why they can make money and then earn their livings, right? Again, when you buy this security Exxonmobil today at the current price is 38.58 or 56, right? That's a transacted price. But the quote, okay, bid quote or ask quote is not 38.58, but that's 38.45 and 47. Wait a minute. 38.45, 38.47. Okay, there's a 2 cents difference. 2 cents difference for each share. Okay, each share. And then the transaction takes place at what? 38.45. Or sometimes it is taking place at this bid price. Sometimes it is taking place at this ask price, right? Within this bound. And then together, in real time, okay, every millisecond, this bid and ask changes in real time. Is the band. And then this bid ask spread, we call it the spread. Bid ask spread, okay? Sometimes widen, sometimes narrow down, okay? Sometimes narrow down. Why does it get changed? Well, think about it, thinking about this spread as a compensation to the middleman. The middleman takes some risk. Or what kind of risk? Well, inventory risk. The middleman, the dealer, has to keep this Exxonmobil in his pocket until the next buyer comes to the market and I want to buy Exxonmobil, right? Of course, in ExxonMobil's case, everybody wants to buy and sell every millisecond. So that kind of inventory risk is not that big. But if it is a small stock that nobody even knows, right? Then you may have to keep this stock for infinite amount of time. Okay? What if the value or the price of this stock, that small stock, plunges down, okay, while I'm holding it as a middleman? You're screwed, man, right? So I want to get compensated for that kind of risk, right? The inventory risk, right? So so large portion of this bid-ask spread has to do with the dealer's inventory cost, right? Inventory cost. And then it has also is directly related to the insider information or private information. If there is some, more insider information that is not disclosed to outside investors, the middleman as an outsider, keep the spread higher. Okay, because there is a more uncertainty. Okay, the insiders, they have something coming up, very good news or bad news, we don't know. Okay, but there is something going on, but the outsiders, we don't know. Okay, how can we know that there is more insider information going on or not? That's something you study in some area called market microstructure. Okay, not covered in this class. But more information on certainty, the dealers get spooked. Oh my God, something going on, and I'm going to increase the bid and ask spread so that I can get compensated more. Okay, that kind of thing is going on in bid-ask spread. So why is there some bid-ask quote and that is never meeting each other, but it's separate and bid is lower than ask, right? This is why, okay? At least you can tell your mom and dad about why we see bid and ask quote every second as you trade in the stock market, okay? Now, you see daily range and then 52 weeks range. Daily range is what? Well, on this day, this is the high and low price, transaction price that this stock hit. This is Exxonmobil, okay? Oh, by the way, why did I say I found some strange thing going on? Typically, bid price is lower than ask price, right? But if for Tesla, it was the other way around, which is kind of, very strange. Because sometimes in a very rare situation, things may happen, or maybe system error. I don't know. Okay, honestly, I don't know at this situation, but very strange. But it has to be this way. Bid, ask kind of things should happen, right? Anyway, so 52 weeks range. What is 52 weeks? Well, that's the number of weeks within a year. Typically, we have 52 weeks. Okay. So that means like over the trailing 1 year, right? This is the minimum and maximum price of Exxonmobil. Okay. And then, by the way, Exxonmobil's today's price is up by 2.18% compared to the yesterday's closing price. Why is it up? As you saw in crude oil, okay, crude oil price I showed you, it was 8% up, okay? So this oil company or petrochemical companies, when their raw materials value goes up, their stock prices go up together with it. largely this raw material cost, they can, how do you say, make it go through so that they will increase their profit margin later on, so that the consumers will pay for that increase in oil price, but not them, right? And then they have a lot of inventories of oils themselves, so that they can resell it to somebody else, or all this kind of benefit is happening. So that's why. Anyway, volume of this stock, what is that? That the 7.174 million shares. That is the trading volume, okay, that happened on this day since the beginning of the trading of today, okay. 7.1 million shares were traded, and then average volume, okay, average volume is like daily average number of shares traded, okay. Remember, number of shares outstanding, it could be billions of the shares waiting for you to be traded. Of course, the number of shares outstanding is there, okay, by, how do you say, 정관, or kind of this kind of bylaw, corporate bylaw, they already set it up. But out of the number of shares outstanding, the shareholders say certain portion of it will be floated in the market. Not all shares outstanding are traded and allowed to be traded. Only a small portion of it, okay, or not small, but some portion of it will be traded and floated in the stock market. The remaining part will be kept to the insiders, the CEOs. They don't want to lose their ownership too much, right? Because they want some control. So some shares are traded in the market. The float, we call it float. And then out of those float, not everything is traded every day. Only a small fraction of it will be traded, okay? And that traded amount of shares, number of shares, is trading volume. On a daily basis, we count it. And then average volume tells us about the average number of shares traded every day over maybe 1 year horizon, I think, trailing 1 year horizon. 32.5 million shares are traded, okay? And now, today, at this moment, 7.4 million shares have been traded, okay? So about what? 1/4, okay, a quarter, slightly more than a quarter of shares were traded until now, compared to the average. Of course, it is only the beginning stage, morning session, okay, going on over there in US time. This is only 10 a.m. Good morning, okay. And then market cap, that is 시총 in Korean terminology. Number of shares outstanding, okay, number of shares outstanding times the price per share. Okay, 38.77 times the number of shares outstanding. Of course, I should have said it differently. Usually, this one, number of shares outstanding times the price per share as of yesterday end. Okay, what was that? Yesterday's closing price, previous close, right? This guy times the number of shares outstanding. Again, market cap is not about the number of shares traded. Okay. Trading volume? No. The number of shares outstanding. Okay. But this is the market value of equity. Okay. Based on this share price, market value of equity. Based on the price. And then beta finally is here, 1.12, right? 1.12. And then you see PE ratio. This is 11.5 times. So for $1 of net income or earnings per share, right? The investors in the market are evaluating the value of equity or price per share as 11.51 times the EPS. Okay, for each dollar of net income, the investors are appreciating, 12 times, right? 11.5 times. I'm going to pay it for you. All right. That's the PE ratio. EPS is right now 3.36. So if you multiply this guy by PE ratio, then you should get price per share. So what is that? 11.51 times 3.36. Okay, and if you do the math, you will see it's close to or end price, okay, ending price of yesterday, or like that. It doesn't change. It doesn't get updated every second, PE ratio. Okay, and then earnings date. That is your next earnings announcement day. Every quarter, after finishing a quarter, they do those accounting reviews, right? This is where the CPAs gets useful, right? Those accountants work for this company and then certify, okay, whether their accounting report has been done solidly or not, and then they finally sign it together with the CFOs and CEOs, and then they get a conclusion about their performance, net income somewhat, and then EPS somewhat, right? And then they announce it to the market. When? Well, the first quarter finished yesterday, or the day before, March 31st. And then April 23rd to 27th, this period, any one day, they will pick, Exxon will pick and announce it. And last quarter, we did this and did that, right? So the earnings news, that's worth paying attention to. Why? Because it will reflect the shock that Exxon experienced over the last quarter, which is the worst quarter that we ever had, right? So a lot of surprises, negative shock will be there in April, last week of April, okay? We call it earnings season, which means not only Exxon, but also many thousands of, hundreds and thousands of listed or publicly traded companies announce their quarterly earnings result. Okay, they cluster in time, so that we call it earnings season. A lot of information comes out over there, and then price, market price reflects those earnings number, and then change accordingly. Let's see what it happens. By the time you see this video, okay, you will have 1 week left, or it will be the same week. Okay, let's see. And then forward dividend and yield. Well, this is dividend yield, right? Dividend yield. Well, that is dividend amount divided by the price. Okay. We have the price 38, or yesterday's closing price $37.5 over there. And then for dividend yield, you need future dividend, okay? Because it says forward dividend, okay? And why do we need dividend yield? Because we want to estimate how much to expect, or how much of a dividend return that we expect. As we invest in yesterday's price, this will be the cash return, okay? Cash return. So let's see, dividend yield based on it, right? 9.17%, right? Right. So dividend yield 9.17%, okay? So 3.48 is the expected dividend. This is the expected dividend. Either the company announces you should expect this amount, or most probably the analyst who is studying Exxonmobil have some consensus level of dividend going into the future. Next year dividend will be, they say, $3.48, right? So divide this guy by what? 37.53. It's roughly 9.17%. That will make sense. Okay. Good. So that's dividend yield using forward dividend. And then ex-dividend date. That is the date when the dividend payment is declared. On this day, if you hold your stock February 9th, right? February 9th, if you held Exxonmobil, then you have the right to get that cash dividend into your pocket, right? That's ex-dividend date. After February 9th, tough luck, no, okay? This dividend will not go to you, okay? We have to set some standard for paying dividend. Let's say that's the idea going on, all right? 1 year target estimate that you see over here, what is that about? Well, that is the sell-side analyst consensus about the stock price of Exxonmobil, okay? They busily work and study about this company, and they say this 49, on average, they say $49.55 is the one, okay, that this share price will be in 1 year horizon. I.e., this should be their true value they estimate, okay, which will be realized in 1 year horizon, okay. That's what's going on. Good. And then, right, as I discussed this ExxonMobil's information, you see some price movements in real time. Yeah, of course. And then what we are interested in is beta. Okay, beta 1.12. Okay, 1.12. So 1.12. Can we infer anything from this number? Okay, by the way, right? Using security market line, what can we infer basically? Security market line. I erase this one. All right. I erase this one. And then, good. Security market line. Here in the horizontal axis, you have what? Systematic risk measure, beta. Okay? And then, vertical axis, expected return of your security. Okay, later on, we're going to switch it into required rate of return. Okay, but expected return 5. Okay. Now, what was the idea of security market line? Over here, right? The relation between market risk, systematic risk, and the security's expected return, and straight line, yeah, I have to dump it, okay? This guy, all right, straight line, risk-free rate when there is no systematic risk by definition. And then when beta is 1, what is the expected return of this security? Well, it has to be identical to market portfolio. Okay, ERM. Okay, market portfolio return. Now, ExxonMobil, okay, at least based on historical data, it says 1.12. So beta has to be here, 1.12. Right? So, is ExxonMobil riskier than the market or less risky than the market? At least in terms of systematic risk, right? Is it riskier than the market portfolio or less risky than the market portfolio? It is riskier than the market portfolio. That's one basic intuition you always have to check, right? Market portfolio 1, and then it's greater than 1. It's riskier than the market portfolio, all right? And then in equilibrium, and if the market, that means that if the market is efficient and reflecting all the information in true ways, then what should happen? Its expected return for Exxon should be on this security market line. Okay, security market line. But, remember this? P equals cash flow divided by R minus G, right? You have dividend over here, future dividend, right? For example, expected dividend 3.48. Let's stick in 3.48, right? And then the growth rate, we don't know, but you can just put in, stick in some number over here with your expectation. And then you stick in your current stock price, which is, let's put it, yesterday's ending price, which is what? 37.53. Okay? Right. Then in this mathematical equation, there's only one unknown. That will be this guy. Your discount rate of Exxonmobil. We don't know. Okay? What is the expected return that justifies this expected dividend and price and the dividend's growth rate or cash flow growth rate? Okay? I don't know what number it will be, but let's say we have some consensus growth rate, expected growth rate. Let's say 1% or something like that. Okay, the analyst in the market will have some good information about the net income growth rate. Okay, use it over there. But the only unknown in that case, that will be this guy. This is something called expected return. And then this return. Would this be the same as this required rate of return? Say RRR. Will it be this guy? Is a valid question. Okay? For example, let's assume this guy is true. R should be G plus what? Dividend over price. Okay? Makes sense? Right. You flip it and then take G to the other side of the equation. That's this guy. So 1% plus dividend over price, 3.48 expected dividend divided by yesterday's price. 37.58, 53. Okay. So that's what the expected return of Exxonmobil is 10.27%. The question is, we know beta of Exxonmobil is 1.12. Okay, then would this 10.27% be on the security market line exactly, or would it be somewhere above or below? Okay, would it always be over here? Everything will line up on security market line only when the market is efficient, and which means in the equilibrium. Okay, so I should line up over here. Where would it be is a valid question. For this part, we need to draw a security market line precisely, and we need some assumption about this slope, which is market risk premium, and then we need some information about risk-free rate. For that purpose, let's assume the risk-free rate to be 1 percentage point over here. Okay, risk-free rate, and then plus beta times RM minus RF, market risk premium. Let's assume it to be 8%. Okay, don't ask me why. I'm just throwing out a number, right? And then multiply 1.12 beta. 1.12, where did it come from? Well, I just quoted this 1.12 beta. Okay, if the risk characteristic, market risk level of this Exxonmobil is still 1.12. Okay, so this should hold, right? Then I can compute the required rate of return of Exxonmobil. Okay, so compute this guy, and this one will be, this guy is based on the security market line that I draw over there, right? I just gave the intercept and slope term as I wish. Okay, so let's assume that holds true, and then give me the required rate of return. Okay, now, so what is that? 1.12 times 8% plus 1%. That's 9.96%. All right, makes sense? That tells me that this number over here has to be 9.96%. And 10.27% is what? Over here, right? Above the security market line, okay? In this case, is Exxonmobil overpriced or underpriced? Can you determine? It is underpriced. It is underpriced, right? Undervalued. I mean, don't get confused. Undervalued or underpriced, we mean the same thing, okay? And then overvalued, overpriced, we mean the same thing, okay? Overvalued. If the expected return, okay, expected return is above the security market line, it is undervalued. Why is that the case? It always confuse you, but it's always talking about how your market price is relative to true value. Okay, that's why we say, oh, the expected return is above what what the required return has to be, which means you're discounting too much. Okay, and true value, is bigger than the current market price. The current market price is too low, undervalued or underpriced. So buy it. The recommendation will be buy. Let's say this is true. Then over time, what should happen? Undervalued, many people will say buy, recommendation. So the demand for Exxonmobil will go up. The price will go up, and then the expected return go down because there's inverse relation going up. So expected return will go down, converge to required rate of return on the security market line. Make sense? Yeah, supply and demand over time, that should happen. That's the idea. When it is overvalued, it's the other way around. Oh, that's too expensive. I'm going to sell it or short sell it. So the supply of the security increases. So the price goes down, which means your expected return will go up. Up and up and up and up and up until it converges to security market line. Make sense? The required rate of return. Okay? That's it. So, so that's frequently asked questions in CFA exam as well as my exams. So I'm going to ask you this question. Get ready for this one. All right. So beta. Okay. You can obtain this beta in Yahoo Finance or Google Finance or whatever finance, right? It's, what is it? 5 years monthly return, okay, based ones. And can you find similar things in Naver Finance or Daum Finance? You can do it. Finance.naver.com. The trouble is that it is only in Korean language, so non-Korean speaking people will have trouble of it. But I hope they also establish some English-based version so that they will diversify those investor bases somehow. Maybe you could do that going to Naver later on, okay? Go ahead, let the people know about Korean companies, please. Why not, right? Now, here, if we look at the Naver Finance, you see 현재가, 전일 대비, 등락률. Yeah, it's self-explanatory, right? Trading volume, 거래량. And then 거래 대금 is like multiplying this 거래량 or volume with this price. And then 상한가, 하한가, there's a price limit for every security, 30% up, 30% down. Otherwise, the stock market, will be unstable for, this emerging market. So 30% limit is there. In daily limit, right? US market, they don't have this 상한가 or 하한가 kind of limitation. So at one day, all of a sudden, your stock can go to zero, bankrupt. We call it jump to default. Crazy. That happens sometimes. On the other hand, sometimes the price jumps like 5 times in a single day. Okay. So that's crazy. It happens sometimes. Anyway, and then in Korean market, you see PER over there. PER, what is that? This is Samsung Electronics, but by the way, PER, 푸긴 뭘 퍼? 똥퍼? Kind of things, right? PER, PE ratio, okay, PE ratio. So 14.78 times, which means for Samsung Electronics, for every dollar of EPS, net income, okay, investors in the market are evaluating it as willing to pay 14.78 times for each dollar of net income as a stock price. Okay, that's that. And then 52 weeks high or low, right? Trailing 1 years, right? This is the maximum price. And then 시가총액, that's market value of equity, which is the price per share times the number of shares outstanding. Again, this is not times multiplied by trading volume. Okay, trading volume is only a small fraction of it. Okay, small tiny fraction. Market cap is about the whole thing laying behind. And then 외인 현재, what the heck is that? Well, that's the number of shares held by foreign investors. Who cares about this? Is it a racist country or what? Okay, what's wrong with foreigners? Why do you have to discriminate foreigners, right? That's something I don't understand, but this is just built in Korean stock market system. Somehow that xenophobia is built in over there. It's following Japanese market maybe, or maybe other countries as well. But in US, they don't have this kind of distinction. Everybody is foreigners, everybody is domestic, who cares? But here we have that kind of things, right? And we typically blame bad things to foreign investors. Okay, why did you get screwed? Because the foreigners sold and the cabbie were buying it. We poor cabbie. No, come on. Domestic institutions are also rationally working on it, and then they make money. Okay, institutions feed on those individual investors anyway, regardless of the nationality. Come on. And you say 검은머리 외국인. Yeah, I used to be one of those 검은머리 외국인 anyway. And your friends and my friends, right? They are working in Goldman Sachs Korea or JP Morgan Korea. They are 외국인, but they are my friends and they're Koreans anyway. Who cares? Why do we be racist over there? We don't know. But that's what the journalists like, because it's fun to pick on somebody else, right? And blame those bad things to outsiders. It's not your fault, poor little cammies, right? That's the sentiment going on. Anyway, 매도 호가, 매수 호가, that is bid-ask quote, right? As I told you before, bid-ask quote. As you see, 매도 호가 is ask quote, and the 매수 호가 is like bid quote. Okay, 사실 때, 파실 때, kind of things, right? And then 전일가 is like a previous day's ending price. 시가, 고가, 저가 means like beginning price, highest price or lowest price on that trading day. Okay, and then 전일 상한가, 하한가, like a maximum price limit in the previous day. EPS, earnings per share, right over here, and then 52-week minimum, and then 상장 주식. This is the number of shares outstanding, as I told you before. And 자본금, this is like a equity, book value of equity. Okay, so that's that. And then where is beta? Where is beta? 종목 분석. If we go there, 종목 분석. It takes time. All right. Yeah. Yeah. In 종목 분석, this is the analysis, quick analysis of the stock, Samsung Electronics. Now it says 시세 및 주주 현황, right? Okay. What we need, beta, is over here. 52 weeks beta. Okay, 52-week beta. 1.05. They ran regressions over the trailing 1 year, and then 1.05. Is it riskier than the market or less risky than the market? It is riskier than the market, slightly riskier, right? Slightly bigger than 1. Okay? 외국인 지분율, that's proportional, like ownership by the foreign investors, non-Korean investors. Who cares? But sometimes we care, okay? And then when it comes to national security, right? Besides the blind discrimination against like a xenophobia, right? For the case of national emergency, the government, right, try to protect their nationally important companies within the control of domestic investors, right? They have some tight control, not to lose their key companies to outside foreign countries. So they pay attention to this kind of things as well. Okay? 외국인 지분율. What if Samsung Electronics is taken over by foreigners so that it will work against Korean people, right? Yeah, we are facing this national crisis or global crisis. So food security issue is there, right? Some countries say, we're not going to export any rice to you guys. Vietnam is doing that, or many other countries are doing that these days. For this purpose, we may be worried about this kind of foreigners' ownership. What if it gets out of control? But so far it's okay, right? It's not food. It is a food for ITC, right? Industries globally, but it's reasonably there. Okay. Okay. Now, yeah. Those numbers are basically what we typically discussed before. And then 주요 주주, you see like major shareholders, right? Who is holding it? Okay. As you see, 국민연금공단 over here, which is National Pension Fund, holds about 11%, and 이건희's family holds like 1.22%, right? And then BlackRock and fund advisors, right? That's biggest asset manager of the whole world, right? It's holding 5% plus ownership. We can expand this and then see what subsidiaries of BlackRock is holding Samsung Electronics with different percentage points, right? BlackRock has a family of funds. Oh, son fund or daughter funds and then granddaughter funds, right? They're holding Samsung anyway. 이건희, 예, 건희 형님, 네, 안녕하세요, right? His family, founding family, how much do they own? Well, not just the founding family, his wife and then son, but also his 안규리, it sounds familiar. And then, anyway, Samsung Group companies, right? Affiliate companies, they hold a significant portion of it. So that's Samsung 생명 life insurance company owns like 8% to protect the voting rights so that it would be under the control of the founding family, right? So that's that. Anyway, so that's how we read this Naver Finance. And then getting back to this beta issue, can we run regressions and estimate beta is a question. Okay, is a question. For that part, I'm going to take you to the stock price data of coming from CRISP, CRSP, which is the University of Chicago's database. And I'm going to demonstrate about this one. Okay, but before I demonstrate to run regressions, okay, I want to set some basics about this regression. Okay, tell you the story. Okay, interesting story about regressions. Okay. You must have learned running regressions from your statistics 101, linear regression, or ordinary least squares regressions. Okay? It is often used and a very important element in machine learning, right? So you must be excited to learn about it. Right. So who invented linear regressions? Who invented this wonderful machine? Who is it? Don't you want to know who invented it? And many people say, I don't know. I was just memorizing all the things and then doing the numbers and I was getting right answer. Never thought about who invented it, but there was an inventor, right? So here is the story, okay? It was Carl Friedrich von Gauss. Okay, let me write down his big name over here. Gauss, a German mathematician. Can you read it? Gauss, yes. Carl Friedrich von Gauss, about 250 years ago, right? Now, what was the story there? In his age, right? There was a mathematicians or astronomers competition, right? There was a comet coming to the Earth, or the Ceres, right? I don't know how they pronounced it, Ceres or whatever. Ceres is coming, and the competition was about this. Well, who can predict the trajectory of this Ceres, 궤도, 행성의 궤도 kind of things, right? Or wouldn't it be round shape or something? But for them, this was not about the round shape thing issue, but in the sky, okay, over the next next 6 months or something, where would it go? Okay, where would it go? Who can predict it the best? In the most scientific and solid way, okay? Logical, scientific way of predicting this trajectory of this star or comet, right? Comet. That was the title of this, or the name of this game, okay? So all the mathematicians and then astronomers were competing and then writing papers about it, okay? Did the competition, and then Gauss won the biggest prize over there. So what was his idea? He looked at the sky at the night time, okay? And then if he were a musician, he would have said, 저 별은 나의 별, 저 별은 나의 별, 별빛에 물들은 밤같이 까만 눈동자, right? Like this. I know, okay, which stars this Ceres will, how do you say, pass by, okay? I know the neighboring stars who will be on this trajectory. I don't know precise trajectory. God knows what. I don't know. But I know that this Ceres will go closer to Venus, closer to Uranus, and closer to Jupiter, or maybe Cassiopeia, or all these kind of Orion kind of things, right? And then, guess what? For mathematicians, right? For mathematicians, he's not a musician, by the way, okay? For mathematicians, they're living in a very simple world. Everything, the stars, is just dots, okay, dots, and then the universe is just XY plots, okay? Two-dimension world, let's say. Forget about three-dimension. Simplify it, okay? So XY, axis, I can think about, all right. And then this comet, right? Trajectory of the comet, let's assume it to be straight line, okay, straight line. Is there guarantee that it's going to be straight line? But let's assume it to be straight line. And that needs certain characteristic, okay? This is going to be a straight line, okay? This is going to be a straight line. And then for each, how do you say, x value over here, okay, I'm going to estimate a linear a plus b x, equals y. Estimate this line somehow, okay? And this line has this characteristic so that at whatever x value you can figure out the y predicted value over here, right, for x value. And then the characteristic of this line is that the residual, something called the residual, okay, the distance between the actual value and the predicted value, okay, will be minimum at any given x point, right? Over here, over there, over there. The summation, the important thing is the summation of this distance squared, will be minimum. So did I say right? I'm going to call it epsilon, the error term, the deviation, right? Error term, error squared, y squared, because the error could be minus or plus, but I'm interested in the magnitude of it, okay? But why not absolute value? But because absolute value is difficult to analyze mathematically, but square term is a better in doing mathematical analysis. So let's square it, and then each time it will be epsilon I. We will have many epsilon i's. So summation of I equals 1 to n, okay, number of observations, which is the number of stars. This will be minimum, okay, with certain value, at certain value, A and B. They have to satisfy this condition, minimum least squared error, okay, least square distance. So OLS, ordinary least squared regression, was born with this idea. And then the astronomers were genius. Wow, we never thought about that before. Other strange ways were proposed, but they were dumped, I guess. This guy won the first prize in this sense. Now Gauss, right, was assuming something in addition. Okay, these stars, all these things are randomly assigned, and then another assumption is that these errors, right, the errors are normally distributed, by the way, normally distributed, okay, for each any given point of x's, right, x2, x1, so normally distributed means like these, and these, and these. If you think about some kind of a 3D plot, right, 3 dimension, normally distributed, not only that, but also the standard deviation of these errors, okay, standard deviation of these errors are the same, we call it homoscedastic, right? And then if this kind of assumptions hold true, okay, OLS gives you best linear unbiased estimate, BLUE, best linear unbiased estimate, okay, if this kind of assumptions holds true, okay, blue, right. That's what's going on with the let's say Gauss-Markov theorem, right? This is a building block of the OLS regressions, right? And it started with the stars, starry, starry night, paint your palette blue and gray, and this kind of things, right? So, quite an interesting and romantic introduction to me, I think, right? I don't know how you take it, but that's that. Yeah. So, what's the idea? Okay, what's the idea? In 250 years ago, regression was, some fun material for these astronomers and mathematicians. But 200 years later, right? 200 years later, finance guys took it and they say what? Well, you say stars, we say stock returns. Okay, stock returns. Well, every day by day or every month by month, there must be some stock returns going on, right? And then there's an important return that we care about, which is market portfolio's return. And then that market portfolio's return has to do with systematic risk. And then, depending on the market's return, how sensitive is Tesla's return, okay, moving, okay? This regression gives a nice, wonderful framework of estimating the sensitivity of one security against the market return, okay? So let me wipe it off. Gauss-Markov theorem and all these kind of things, right? But I will leave the picture as it is. I will replace this label x-axis as what? Return on the market. Rather, I would say excess return. Market portfolio's return in excess of risk-free return. Why? Because we are interested in the risk premium, the excess return of the market portfolio. Okay? And then this should be explaining the excess return of Tesla. In excess of what? In excess of risk-free return. Okay? So risk-free rate, excess return of your security, Tesla or Exxon, whatever you're interested. Okay, excess return explained by excess return. Your company's excess return, how sensitively does it move relative to market portfolio's excess return, commonly in excess of risk-free asset, right? So that's basically it. To get the characteristic of your company, the beta, called beta, we call it characteristic function, okay? So if you trace back in history about your stock's return over, it can be 5 years, it can be 3 years or 1 year, okay? Historical data, you obtain the excess return and then excess return of the market. Okay, and then you can run a linear regression and estimate the beta over here. I'm going to Ri minus Rf, the whole thing will be, can you see it? Right, alpha plus beta times Rm minus Rf. This is nothing but x, right? This is nothing but, oh no, come on. This is nothing but y, this is nothing but x in your axis, right? Yeah. So that's what's going on, right? You're estimating beta and alpha, all right? So far so good, right? So far so good. So this is excess return, regressed on excess return, right? Estimating alpha and beta. Now, this is a characteristic line. We call it characteristic line. Don't get confused with security market line and capital market line. I told you before, 3 things are different, right? Characteristic line, what do you have on your x-axis and y-axis? This is excess return, right? So that's different. You estimate beta of your stock. I could be Tesla, I could be Exxonmobil, right? So to be precise, this has to be the case, right? And then, capital asset pricing model assumes that this market factor explains any security's excess return fully, so much so that nothing is left unexplained on average. For certain stock, some intercepts may be there, but if you run this kind of regressions, not just for Tesla, but if you run regressions for thousands of different stocks, can you imagine running regressions 10,000 times, right? Repeatedly running regressions for different stocks, right? Then you will get estimates of alphas and betas, 10,000 times of them, right? And capital asset pricing model says the average of this alpha estimate will be nothing different from zero, which means alpha will be non-existent. What does that mean? Well, in this picture, right, on average, this intercept has to be no different from zero. Has to be going through this, essentially it means the intercept will be zero or so, right? Zero on average, right? That's a basic argument of capital asset pricing model. Okay, we're going to get back to this alpha later on. Okay, so assume that this alpha is zero. Then what happens? Here's the interesting thing. Now Ri, let me copy this thing. Ri minus Rf should be equal to ignore alpha because this is going to be zero. Assumed beta hat I Rm minus Rf. This should hold true, right? Now it's getting closer to what we wrote down before. How? Let's move this guy to the other side of the equation. Oh, Ri equals Rf plus beta hat I Rm minus Rf. Wow! That is the equation that we had for security market line, SML, SSSN, M. But what is the difference? SML, what was the horizontal axis variable? In SML, this guy was your x variable, okay? In characteristic line over here, okay, your x is this guy, and this one is nothing but the slope of your characteristic line. The coefficient and then the x variable flipped, okay? That's a superficially understanding the distinction, right? A lot of more fundamental distinction has to be there, but this is one way of it. And this is why people get so much confused between the characteristic line and the security market line. See, beta was there, but what was there? Okay, a characteristic line. This guy is just the the slope term, the coefficient. Okay, you look at this diagram, right? So each and every stock you can estimate the beta in this way. Okay, in this way. For this purpose, what do you need? Not only your stock's return, but also risk-free return. You need it. Okay, risk-free assets return day by day, but that's somehow not easy to get. But to the extent that this guy will be small enough, and then this variation will be ignorable, and this one shows up again over here as well, right? Why don't we, for our easiness of calculate the estimation for undergraduate purpose, right? Why don't we ignore our f for a while and then run a regression, okay, RF for a while, for example, over here and over there, right? Just collect those stock return and then market index return and then run a regression. Okay, run a regression, a linear regression, and estimate the beta, which will be really, really close to the strict CAPM regressions anyway. Okay, the error will be there, but it's ignorable. So why don't we just run regression using this? Okay, is what's going on. Typically in your the textbooks or any undergraduate level discussion. Okay, in PhD level or hedge fund level, you have to think about this RF. Subtract it out, and you have to be really, really precise. But in undergraduate corporate finance level, that's okay, right? Run with these two, right? And estimate the coefficient beta, the characteristic line slope, right? So let's do it. Let's do it here. All right. So what do we have? Over here, I collected Exxon Corporation's, Exxonmobil's stock return that you see. Can you see it on your screen? Maybe I should magnify this thing. All right. This is coming from CRISP data. University of Chicago collects this security prices data in the stock market, United States, in a very nice way. And what you see is PUM number, permanent company identification number. And then each company throughout its life, from the birth to the death, they're going to have identical one PUM number. Okay. NQSIP is a security number that may change sometimes, but you can ignore it for now. COMNAME, this is company name, Exxon Corporation. This started actually, originally, this was Rockefeller, John D. Rockefeller's company. Okay, it was split because it was monopoly power, and the Franklin Delano Roosevelt said, "No, you're too much big. You have to split it." And then Exxon was the biggest of this. And then PRC, it's not People's Republic of China, but this is price of that stock at the end of the day, closing price. And then RET means what? Holding period return. In this case, this is monthly return data. You see date, you see, double click it, and you will see end of each month. The trading day, last trading day of each month is shown over here. And then the closing price, and then based on this closing price, you can obtain the return. Don't ask me how they got this return of the 1st November. Okay, this means that it already had 1972 October 31st data. Okay, but I skipped it and then started with the November data. Okay, so please understand it. Anyway, share out. This means the number of shares outstanding. It's not a trading volume. That's why it is fixed over here for a significant period of time. Okay. Of course, as the company splits their stock or gives some stock dividends, the number of shares outstanding increases. Or when they do reverse split of stocks, their number of shares outstanding gets reduced. And is it a common phenomenon? Well, take a look at our good old friend, the Samsung Electronics, right? The number of shares outstanding increased multiplied by what? 100 times. Why? They wanted to split the shares, right? So that all the individual investors could buy and sell more frequently, okay, more easily. That's something happens, right? Was it 100 times or something? I'm going to assign it to you as a homework. Anyway, VWRETD, what the heck is this one, you may say? This is market index, value weighted return, including dividend, using all the United States stock. This is the very market portfolio that you can possibly imagine. It's going beyond the S&P 500 stocks, right? Notice that S&P 500 includes only 500 top companies in market cap. But VWRETD is like the University of Chicago collected this data about all the stocks in the US. They computed the average return of this, value weighted average return, day by day or month by month in this case. So what can I do? Well, I am interested in obtaining the beta of this company. And in Exxonmobil, as you see far down, right, farthest down, the data is available up until December 31st last year, quite close to what right now, right? So what am I going to do? Well, let me copy this data to the next page. Always I just make it a habit to make a copy. I am afraid of losing data. And then I'm going to delete most of the part, and then I'm going to what's that? Focus on last 5 years data. Okay, last 5 years. This is 2020, but 5 years, including 2019, right? So that means like 19, 18, 17, 16, 15. Is that right? Right. 2015 will be my beginning period. 2015. Right, so before 2015 I deleted. Okay, how many observations do I have? 5 years, so I should have about 60 observations. Do I have it? Yes, there we go, 60 observations. And then I also make it a habit to set the first line as fixed. Fix my first line. Okay, so that I scroll down, nothing changes on the top. I don't need shares outstanding this time. All I need is the return. I don't need NQSIP. Well, date, maybe I need it, but what do I do? Well, based on this return and market return, I should say RM over here. Okay, and this one R underbar XOM, I would say, Exxonmobil's return. And I'm going to first create a scatter plot like this, starry night. Okay, so shall we do that? Go to insert, and then there are a lot of chart options. So I am interested in this scatter plot. Okay, so let's say first do a scatter plot of it. Okay, and then it says, well, RM is on the vertical axis. Is that right? Is that something I wanted to? Okay, that's something I have to be careful about. So I want RM to be on the horizontal axis and ExxonMobil on the vertical axis. I may have created wrongly. So how do I check it? Well, don't panic, right? Right click on this chart and then look at the data selection, right? And then here RM. So then right, if you click this edit on the left hand side of your dialog box, and you can see what is on the X and what is on the Y, right? And then it says the X is supposed to be D column, and then Y is supposed to be E column. Oh no, I want to flip it. Is that possible? Not directly like this, because this is scatter plot, right, situation. So cancel it. But don't panic. What do I do? Well, designate again. Assign the X value and Y value again. I want to come up and then scroll up. Yes, over there. By the way, let's save it because I want to, did you see this scroll bar increasing as I punch in Control S? Right, it limits down to the data as much as available. I'm going to delete this guy, but I'm going to cut Control X and go here and then insert RM column over here, and then again select these two columns. Okay, select these two columns again, right? And then insert scatter plot. Yes, like this. Okay, which makes sense because, okay, Exxonmobil, whatever is on the y-axis is specified as title in the scatter plot. All right, just to check the data, and then edit over here and make sure X value is in the D column, RM, Y value in E column, right? Yeah, confirm, and yes, and then get back to our scatter plot. So, starry, starry night, we see the blue stars, a lot of them, all right? Now what? Well, if you right click on this one, any dot, you will see a trend line, okay? Add a trend line, and then, sorry, I'm here. Okay, and you have a choice. What kind of trend line do you want? Linear trend line. Okay, this is going to be a linear regression. No log trend line or any other, right? Spooky trend line, no. Funky trend line, you may call it or whatever. And then what do you say? Well, here I want to show the equation of this estimated line, and then I want to see the R squared together with it. Okay, and then I'm done with this. I don't need to see it, right? And you see this strange, okay. You see line estimation over here, okay? Shall I increase this font so that you can see it? Okay, fine, let's do it. Increase the font size to 14. Come on, this is taking a long time. Okay, oh no, turned off. Maybe the video file that I am creating is too big, but let's see. Okay, so it gets back, it recovers fully, yes. And then I say, I want this to be like 14 points, okay? First of all, what is my beta estimate of Exxonmobil? 1.0048, okay? 1.0048. Is this beta estimate, right, identical to the beta that I got from Yahoo Finance? And the answer is no. The answer to most of my question is no. Okay, so here Exxonmobil, what was beta estimate? 1.12. Okay, why is that the case? Of course, it's 5 years estimation, but over the last couple of months, things have changed so much. January and February and March, right? This one includes the most recent 3 months, and that one, mine, does not include most recent 3 months. So that is why. And then number 2, the market index may be different, right? Market portfolio that I assumed RM is based on all the stocks in the US, whereas over here, I don't know what the heck was they were using as market index. Perhaps S&P 500, perhaps Russell 2000 or something. God knows what. So this is one point. When you run regressions or quote outside, when you quote outside data, okay, make sure what is used as their benchmark, market index return or whatever, okay? At least when you are running regression on your own, you are in full control of what the heck you are doing, so you can explain it. Be able to explain what you're doing, right? That's very important. When you're doing I-Corp project, all these kind of things, don't say, I cited this number from whatever source, I don't know what the heck was going on, but Bloomberg says this. You need some more explanation, okay? Do it on your own is the best way. Make sure, know what's going on. Why? Because later on, once you get a job, let's say you work in a fintech company, you're working with engineers. Engineers know how to do the math, but you have to know what to do and you have to give them instructions about what to do. And maybe you have to be the engineer yourself, right? You have to have some fundamental logic behind it. Bolts and nuts and bolts. You have to know it yourself, right? So that's that. And then R squared, okay? R squared, 47% or 0.4787, okay? Well, do we care about R squared or not? This is a stumbling block for you, okay? In marketing or strategy, right? All these kind of non-quantitative divisions, right? They love high R squared. What is high R squared about? Well, the percentage or proportion of the variation of your Exxonmobil's return, okay? Cross-sectional variation of return of Exxonmobil's explained by the variation of market portfolio returns, okay? That is represented by R squared. Again, it tells us about what portion of the cross-sectional variation of your Y variable explained by your X variable. X variables, right? So in usual regression setting, you want higher R squared than lower R squared. That's pretty much what's going on in usual setting. But in CAPM, right? But when you are estimating beta of your stock, when you are estimating this characteristic line, we don't care about R squared too much. Okay, we don't care about it. Don't drop it simply because R squared is very low. Why? Because the market has a lot of random components in it, okay? But we are just taking a glance of what it looks like. Okay, fine, we have some idea, move on, okay? High R squared, it just tells us that historically, in the past, the return of this guy was well explained by the market. Okay, well explained by the market. Does that mean that it's going to be, well explained by the market in the future, going into the future, out of sample forecasting? Nah, not that much informative, right? That's one thing to notice. No guarantee, okay? That's one thing to notice. And we're gonna prefer something called bottom-up beta instead of regression beta anyway, okay? So you may be tempted to use this R squared as a rule of determination. Not really, okay? So that's one thing to notice. And then R squared, yeah, but it just tells us about the the power of explanatory power of this X variable. Anyway, so that's that. And how about, it's kind of fun, okay, Twitter and Facebook. We're going to go through two more regressions, okay? Let's do it. So in Twitter, we have it over here, right? I'm going to copy this guy and then paste it to the next slide. And we don't need NQC for now. Delete it. And then price or shares outstanding, we don't need it. What we need is this value weighted return. And then I'm going to cut it and then insert between these two, right? Twitter Incorporated, company name, and the period, okay? I want to go back in 5 years, right? So 2015 was the beginning of a period. Okay, let's go. So I'm going to delete the period before. Now, what I need to do is draw a scatter plot over here and then plot it. Yes, I should have said return underbar Twitter, right? And then this one is RM, okay? And I already got this scatter plot. Yeah, starry night. And then I want to draw a trend line. And that trend line, I want it to be linear, and I want you to show the coefficient estimates as well as R squared on the chart. Yes. And then, right, increase the font size. I want it to be 16. Yeah. Right. So Twitter over the past 5 years, right? The beta is 0.663. Okay, 0.63. Is it riskier than the market or less risky than the market portfolio? The historical data, based on the history, it says it's less risky than the market. Very interesting. High-tech stock being less risky than the market? How could that be? And then if you look at Exxonmobil's estimated beta, it was even higher than the market, right? Slightly higher. And then Exxonmobil riskier than Twitter? Is that intuitive or not? That's something you have to think about. Okay, we'll try to answer this question later. And then R squared, if you look at it, well, this time the R squared is just 0.025 or something, right? So only 2.5% of this variation of Twitter's return is explained by market portfolio return. Okay, less of an explanatory power. Okay, we just take a look at it and then move on. Okay, less explanatory power, that's the only thing we have to notice it. We still have regression beta over there. Okay, Twitter, yes, right? The next third company is our good old friend or good new friend, Facebook, right? So we want to go back 5 years of history, 2015. Okay, should be the beginning. All right, 2015, January. The data before it, I'm going to delete it. Oh, wait a minute, why did I do this? I should copy it to the next page, I'm sorry, right? And then delete 2000 up to 2014 data. And then delete NQCIP, PRC, and then share out. Okay. One thing to notice is that so many people do regressions wrongly. I saw some students running regressions of the price PRC against market return. No. Okay. As I said before, this is about the return, not about the price. All right. So that's why. Now what do we need to do? I want to cut this return and then insert it at the last column. Yes. And this one is RM. Yeah. And then this one is our return of Facebook. Yeah. Right. By the way, you can find me in the Facebook by finding Andy Kim. And then, okay. Insert, and then you have a scatter plot over here. Yes, again. Yeah, right, like this. Okay? And then what do you do? Well, right click on this and then insert the trend line and choose a linear one. And then I want to see the equation of the estimated ones, right? Like this, wait. Yeah, all right. And then I'm going to expand, okay? Magnify this picture. And now you see it, right? Beta estimate is 1.05 for Facebook, right? Is that riskier than the market or less risky than the market? Well, slightly riskier than the market portfolio. You can determine it. And then R squared, 26%, right? So 26% of the variation in return of Facebook is explained by the variation in market portfolio return. Okay. Compared to Twitter, this is better explained by the market. Well, is it always the case that the Twitter's return will be better explained by, Facebook's return will be better explained by the market return compared to the Twitter's return being explained by market return? Not really. This is really data dependent, right? Going into the future, things may change so that Twitter's return may be better explained by the market later on compared to Facebook return, right? One thing that we can infer from this R-squared comparison is that, well, over the past 5 years history, okay, those Twitter, they may have some more idiosyncratic firm-specific risky news coming up, okay, compared to Facebook, okay, and maybe Facebook's another thing is that Facebook's market cap, okay, grew so big that it takes significant portion of the market portfolio, so that it goes well together with the market. Maybe that's what's going on, okay. Twitter, in contrast, remained as a rather smaller company. Maybe that's why it's not well explained by the market in the first place. You can infer a lot of things from that information. Anyway, another thing is, again, the R-squared being low, don't get panicked, okay? It does not mean that the CAPM sucks or anything, right? It's just we're living with the randomness anyway. We're just getting one estimate of beta. Is this really true beta of Facebook? Is this really true beta of Twitter? We don't know. Okay, we're just estimating it. It may be close, right? It may be close. May not be close. We don't know. That noisiness is something we're going to discuss next step. Okay? Oh, by the way, is it the only way to estimate regression beta? Okay, let's get back to Exxonmobil, our good old friend over here. Okay, is it the only way of estimating beta? And the answer is no. The answer is no. One thing, okay, that you can do to estimate beta is going through data analysis function. Data analysis, if you click data, and then if you click, what's this? The data analysis, data 분석. We don't have it over here. Ooh, you're in trouble. What do you have to do? Well, don't panic. Go to File, and then Option, click Option, and then you will see a dialog box coming up. And then you will see add-ins, and then you're going to see what? Additional function, and then click Move. Alright, click Move, and then you will see 분석 도구 or analysis tool, right? In addition, I mean, this will take care of it, but in addition, I need some euro currency tools kind of things because it's finance. And then confirm, okay? Then it takes time, and then it collects those additional functions to Excel menu, and especially for data part, okay? And you see data 분석 popping up over here. Did you see that? This part? And then you click it, all right? And some magic happens. Okay, fine. Here you see a lot of statistical the analysis tool, like histograms and then ANOVA, all kinds of things. What you need is 회귀 분석 or regression analysis, and say confirm. And here you can specify, okay, what should be the y variable. Oh, by the way, what should be the y variable? And I confirm that there will be a label for this y variable, and then click this guy to specify the range of y variable, including the label. So I'm going to start with this one and scroll down to the last row and enter. Then you specify, I specified Y variable, which is Exxonmobil's return. And then I want to specify the X variable, which is the market return. And this guy, and then click all the way down to this one. I notice that I punched in, okay, first punch this guy, and then shift punch 61. Okay, shift and click this one. Then I assign a whole column of this, right? Like this. And then these check boxes, what do I need to check? Well, I don't think I need to check anything else. Let's be simple here and then confirm. And then it takes time and it throws you the regression results. Oh my God, this is all Korean. How can I read it? Well, I know you can read it. Okay, fine. So this one, okay, what we need is this table over here. Okay, so Y 절편 means intercept term, supposed to be alpha. Okay, alpha estimate, where CAPM said that if you run this kind of regression for thousands of stocks, on average, this alpha will be no different from 0. But that does not mean that each different regression will always generate 0 alpha. Okay? In this case, we had negative alpha 0.00889, and then the t-statistics turns out to be 1.8, which means the p-value is 0.7. So statistically testing, if you test whether this alpha is 0 or not, we will say it's in the margin. If your critical value is 10% alpha, then we reject the null that the alpha is 0. If your critical value of alpha is 5%, we say we cannot reject the null that the alpha is 0. Okay, so that's one thing we can tell. What does this alpha mean for each security? Okay, CAPM assumed that thousands of stocks, on average, that will be 0. Okay, but remember, that's for thousands of different stocks in market portfolio level, right? Thousands of stocks. For each different stocks, the alpha would mean the ability of the CEO, right? If the CEO was managing good, then the alpha, the performance of the company stock, will be positive, right? Abnormal performance. We call it abnormal performance of the stock, right? Y 절편 alpha. In this case, negative, right? If your critical value is 10% p-value, then you reject the null and then say CEO sucked. RM, okay? This is 1, okay, 1.0083, and this t-statistic is 7.23, what is it, 7.3, right, 7.3, and p-value, what the heck is that? Essentially 0, okay, which means if your critical value is 1%, right, 0.01, you reject the null strongly, very, very strongly, that the beta, your slope, is 0. Null hypothesis is always beta equals 0. Okay? This rejection of null hypothesis simply tells you that beta is non-zero, something either positive or negative, and it is significantly different from 0. Right? Notice that the null hypothesis is not whether the beta is equal to 1. We never test whether this beta is equal to market portfolio's beta. Okay, so that's one tricky part.